Greetings, ladies and gentlemen. Welcome back to the long game. This is episode number 2, and today I'm going to talk to you about different types of personal investment accounts. These are the types of accounts that we're going to go over. These are the ones that I'm the most familiar with. Savings accounts, standard savings accounts, and we're going to talk about interest when we talk about savings accounts because that's the important piece for those. We're also going to talk about some government and corporate bonds. We're going to talk about various types of investment accounts and where to find them. And then we'll end the video talking about commodities and cryptocurrency. Let's get started. The advantage of standard savings accounts is that they're everywhere. And there's different types of savings accounts based on what type of goals you want. You can find these accounts in banks, credit unions. Some employers have them, some retailers have them. They generally require low or zero starting funds to open. They can require zero starting funds if you're a younger person just starting out. Late high school, early college age people tend to get these types of accounts. Most of these accounts have some sort of offer attached to it, such as a slightly higher interest rate if you have direct deposit, or auto saving techniques that you can have and attach to your savings account when you open them. Unfortunately, the disadvantages to most savings accounts is that the returns are very, very bad. Based on the types of returns that you can get with other types of investment, savings accounts are the worst. However, they are also the most steady, least risk. Most, if not all, savings accounts are insured by a government entity to prevent full-blown recession crashes in that country's economy. Another disadvantage is that the money in a savings account is almost too easy to access. In the United States, they've passed rules and regulations that prevent or penalize people who withdraw from their savings account more than 6 times a month. You can deposit as much as you want, and up to that 6th time, you can withdraw however much you want. But if you keep withdrawing from a savings account more than 6 times per month, you start to see penalties on those withdrawals. The key to having success with a savings account is the interest that you make on savings, and that interest rate is described in this fashion. Your change, the increase to your money in your account, is based on how much you started with and the interest that you accrued over that month. Those numbers are added together and you get a new amount in your savings account. So we're going to discuss the interest portion of this account. So a little bit of this is going to be mathematically based. So I have put in a marker end of math discussion that I'll pause on for a moment so you can skip past this discussion if you're familiar with how simple interest and compound interest works. But simple interest is the interest that you earn, that I that was in the previous equation that you saw, that is based on the starting principal that was in the account at the beginning of the period, and you multiply the interest rate to it. That interest rate, which we're going to talk about in a few moments, is not the actual interest rate that you're quoted. There's another calculation that you have to modify the interest rate that you have. But this interest is added onto your principal, and then that principal is added into your account. Compound interest is interest that we talk about over a longer period of time. It's described similarly. The interest rate that you earn is based on the starting principal, and then the exponential function, e. The exponential function e is a value of 2.7818, and it's almost always raised to some exponential power, and in this case it's raised to the rate that you were quoted and the number of times that your interest is compounded. End of math. This is all the math that we're going to discuss in this video. So another type of interest that you may see associated with the types of savings accounts that there are is called complex interest. Complex interest is where they say the interest is compounded every X and added in every Y. So an example of this is that your account's interest may be compounded daily and added in monthly. So what happens is every day of that 1 month period, simple interest is calculated. And then they accumulate that simple interest into I. At the end of the month, that accumulated simple interest is then added to your principal to give you a new principal amount. Instead of what happens with compound interest is that the interest is compounded continuously. The key to your savings account is inside of the annual percentage rate. The annual percentage rate is used to compound the principal across the compounding cycle. This is the number that you are trying to beat. The APR is what you are trying to beat when you use some other form of investment. If your investment is only capable of equaling, or maybe it even is actually losing against the APR of a standard savings account, you may want to consider that you need to make changes to the way you invest or the locations that you're investing in. The other number that you'll see regularly is the annual percentage yield, and this is the percentage change of your account that you could expect if you don't add anything to the account. If you only let interest accumulate, the change that you'll see at the end of the year is the annual percentage yield. So before I told you that that interest rate that you see is not this. The key word here is annual. Annual percentage rate is the rate that you get at the end of the year if everything goes according to plan. When you're compounding, however, you have to divide the rate by the number of compounds. So if you're looking at a rate that compounds daily, you take the APR and you divide it by 365 or 366 depending on the year. If your account compounds monthly, you divide the APR by 12. Before you do any of the other calculations with rate, I saw what I should be saying. So some other types of savings accounts aside from a standard savings account is a money market account. This is one of the other types. So a money market account usually will give you higher interest than a standard savings account, but most money market accounts have a very significant cash investment required. That is, you have to open the account with a certain amount. You have to maintain a certain amount that's usually higher than the starting amount in order to get the interest rate that they've quoted you. A lot of these accounts are locked. That is, if you withdraw from the account, even fewer than 6 withdrawals, if you withdraw from the account over the lock period, you suffer a penalty. If you have a balance, an average daily balance that's too low, you suffer another penalty for that. And what makes money market accounts occasionally even more problematic is that some of these money market accounts are actually checking accounts. So not only do you have to maintain the average minimum daily balance, but you have to do that while you're writing checks against it. That has advantages and disadvantages. In my opinion, it's mostly disadvantages. The other type of savings account that's popular at most banks is a certificate of deposit. Certificate of deposit has an interest rate that's somewhere between a standard savings and money market account. It just depends on the bank. Sometimes a certificate of deposit has a higher interest rate than a money market account because you can access your money market account, whereas a CD is perfectly locked. You can put money in, but if you take any money out of that CD before the term length completes, you get penalized. In fact, sometimes the penalties are so high that you end up losing money by putting it into a CD. You invested $1,000. If you try to get the money out early, you may end up with less than $1,000 coming out. However, those term lengths that are offered on CDs vary to suit your tastes. Some of the common lengths, 30 days, 60 days, 90 days, 2, 3, 5-year CDs. The interest rates will increase depending on if you have a longer term, but ultimately the interest rate isn't that much better than a standard savings account. For more information on the different types of savings accounts and the different types of rates that you can get, banks will publish a rate sheet. And this will tell you the rates for the different types of savings accounts that they have and put them up side by side. Again, you'll only see the annual percentage rate, but you can use that in making a decision as to what type of savings account you want and how long, if it's a locked account like a CD, how long you want to remain invested. You can also talk to a bank advisor who is probably going to be the one that provides you the rate sheet. You can also consult the brochure for a particular type of account that you're interested in. Be aware the bank advisor is a little more than just a salesperson. They're going to try and zero in on the type of account that interests you. They may even ask you questions about what you're looking to do with a savings account to try and steer you to the right direction. But ultimately, they're trying to get you to open an account, especially a locked account, so that they can turn around and invest that money and know that they have that money to invest for a lengthy period of time. Lastly, you can talk to your own personal financial advisor. And when you do talk to a personal financial advisor, they're going to tell you not to use a savings account as your main vehicle of investment. More likely than not. Another type of investment account that you can get involved with are bonds. Bonds are usually a loan. Well, bonds are a loan that you as an investor create with some entity. The entities that you can create these bonds with are either the government or a corporation. Usually this loan has a purpose. Just like you take out a car loan or a home loan, the government or corporate entity that you take a bond with is going to tell you in advance, we're using the bond money to do this. However, there are no guarantees that those purposes will remain the reason why the bond exists, or that the bond will continually fund those purposes. They may change what the bond funds. Bonds usually require a very significant investment, possibly a 6-figure investment to start. And on top of that, bonds usually have a very lengthy maturity term. We're talking years and even decades. Government bonds are issued by municipalities, cities, state, county, parishes, local governments, and in some places, even your federal treasury will issue bonds available for public consumption. Federal bonds, at least in the United States, are available through banks. These other types of bonds have some kind of market that they're available to be purchased in. Maybe your bank gives you access to these types of bonds as well, but most of your local bonds, there's a market for it. How to access it, however, I don't know. Talk to a personal financial advisor if you're looking to get into municipal and state bonds. These bonds generally have an established goal. They were voted on by the public. So for a municipal bond, it might be we're going to build a local school. For a provincial, state, county bond, it might be we're going to improve roads. Federal bonds generally don't necessarily have a goal in mind, but they use that money for investment purposes when they're trying to fund something. The best place to find information on bonds, especially local ones, in the United States is proposition documentation. The election day document that gets passed out that you vote on, because these types of bonds are passed as if they were laws. Keep in mind, they're passed as if they were laws. So it reads like a law, which means it's difficult to read. The other type of bond is a corporate bond. Corporate bonds are issued exactly by that. They're issued by companies. You are making a loan to that company. Generally, corporate bonds have a shorter term than government bonds, but there is such a thing as a 30-year corporate bond. So it just depends on what the corporation is trying to do and how much money they're trying to bring in and how long they want those loans to be out. The thing that's important about a corporate bond is even if the company bankrupts, a corporate bond will get you some kind of return, because a bond is a loan, whereas stock is ownership in a company. So if a company goes bankrupt and you own a piece of that company, you go bankrupt right along with it. Now, you don't owe any money or have to come up with anything in bankruptcy court, but the investment that you made in the stock goes away. You will never see any money from that investment if a company bankrupts. If you have a corporate bond, you'll see something back. It won't be the full value of the bond, but you'll see something. The amount that you need to get into corporate bonds varies, but it's going to still be significant because this is going to a corporation for some purpose of building up that company. So those bonds are going to be significant investment amounts that you need to worry about. For more information on corporate bonds, speak to the company's investor relations department that you're trying to buy the bond with. Unless, I should point out, unless you're saying that you're looking to invest in six figures, you're probably not going to get an answer. But you should try and contact them. The next type of account is the one that I'm going to focus on for the majority of this channel, and that is an investment account. This is one where you get to go to the stock market, purchase stocks, purchase mutual funds, purchase exchange traded funds, ETFs. You do that through investment accounts. These are the place where you can get an investment account, your bank. Most banks are starting to recognize that discount investment, that would be individual investment like us. Discount investment is actually a large swath of the investment market, and they should get into giving access to us in their banking arena. You can also go to a special investment specialty house. That's a brokerage or some of your older school, older internet-based investment locations. And lastly, there are quite a few apps for investing. These are no-frills apps that are solely for the purpose of accessing the market. So let's talk about your bank for a moment. Banks are starting to get into discount individual investing because it's a lot more lucrative. They get access to people who don't have 50 grand to drop in the stock market. It is better for banks to have 100 people that have $2,000 than to require one person with $100,000 in order to get access to an investor, an investment broker. Banks are starting to see this. And there's a reason why banks are starting to see this, which we're going to talk about on the next slide. So usually the fund transfers into and out of an investment account are pretty immediate. We'll talk about this type of transfer on the next video. Assistance is usually readily available, but be aware that the vast majority of that assistance is unspecialized. It's your bank advisor who is, for the most part, a salesperson trying to get you into a local investment account through your bank. Some of the disadvantages of these types of accounts, however, is they may have significant minimum deposits, which could be as high as $10,000. Second, They may have maintenance fees, which you're more into discount brokerages don't have anymore. They used to have them. They may also have activity fees, which is something I didn't put on this because very few have it, but activity fee is something that you may see if you try to open a discounted brokerage account through a bank. I will discuss that real quick. An activity fee is a fee that they charge you if you don't trade. So if you don't do any buying or selling for a particular period, whether that's once a month or once a quarter, if you don't do any trading at all, if you just sit, they may charge you a fee for that. Most brokerage houses don't do this anymore, but the ones at your bank might, because they're just now getting into it and they don't realize that, yeah, discount brokers don't do this anymore because it drives people away. If there are account maintenance fees, activity fees, and in some cases transaction fees, that is, every time you do buy a stock, you have to pay a fee. If you see any of those, you might want to look elsewhere. Next type of account is through a specialist. That is a, quote, discount or individual broker. These can come in the form of brick and mortar investment brokers. Charles Schwab, it comes to mind because they recently are trying to merge with my initial discount brokerage house, which was Ameritrade. Other places. Not going to be able to come up with any off the top of my head. I'm not trying to endorse anybody anyway, but these brokerage houses had a specific location for discount investors, individual investors like us. The banks and most of your stock market people refer to us as discount traders or discount investors. They need to stop doing that. It's demeaning. A number of these places are actually starting to offer banking services. So you may find, I know for Ameritrade, they have TD Bank. So you can go and they act like your standard bank with checking, savings, CDs, money market accounts, which is why your standard banks are starting to offer discount investment accounts, because certain people started moving their accounts to these discount brokerages that also offered banking services. So now the banks have to offer discount investment services to keep up in order to keep their customers. Most of these accounts no longer have a deposit requirement to open. Clearly you need to have money in there if you're going to start trading, but most have no deposit requirement. Some of them do. It's usually really small, like $100, basically the same type of amount that you'd need to open a standard savings account at a bank. Very few have maintenance fees on low balances anymore. They stopped doing that a while back. However, the main disadvantage is if you're not banking with one of these discount brokers or individual investment brokers, if you're not doing your banking services with them, then there's a turnaround time to withdraw money to your bank account. It's an ACH transaction. We'll discuss that in the next video. Lastly, you can invest through extreme discount companies. These are only generally accessible through mobile apps. Now, almost all of your discount brokerages have these apps, but there are some where the whole purpose of the app is investing in the market. These apps, Webull and Robinhood are among them. I did have a Webull account for a short period. But another type of account that you're seeing come up are instant investment accounts. These are Stash and Acorns. We're going to talk about those right now. Some of the advantages and disadvantages of these types of accounts is no fee for a standard account at all. So if you open for a standard investment type of investment account, which they call a cash account, there won't be any fees at all associated with these accounts. Passive investment, I'll talk about that in a second. That's Stash and Acorns. I'll talk about that in depth in a moment. These types of accounts, these types of app-only accounts, have fees for things that honestly you wouldn't use those accounts for. The number one example I have is Webull offers IRAs. If you're downloading the Webull app, you're not downloading it to open an IRA. But you can do IRAs on Webull, but they charge you for it. Usually the fees come on margin accounts. Margin accounts are accounts where you're basically taking out a temporary loan in order to do investment. My feeling on that is I don't recommend margin accounts. Margin accounts gets into borderline gambling. I don't have margin accounts. All my accounts are pure cash. Another thing that you get from these mobile only type apps is your assistance is greatly reduced. It's usually email only, and that is the turnaround time can be bad. Not for all of them, but for some of these app only investment brokers, email assistance only, and the assistance is a long time coming. Another thing that you see with these types of accounts is that there's social networking influence or interference. So I'm using Webull as an example on this because I used to be on Webull. Webull had for every single stock, mutual fund, or ETF that they offered, there was a board that you could post to and could have a conversation about that account, that stock on. They would also have sector-based chat boards. We will talk about sectors later, what a sector is a little bit later. And then they also had full-blown market chat where you could chat about the market itself. And the problem with these types of chats is there's a whole lot of talking going on from people who either were trying to sell you something or who didn't know what they were talking about at all because they weren't doing any kind of research. So I want to come back for a moment to the passive investment type of account. Stash, Acorns, very similar. These accounts link up to your checking account or whatever account you have a debit account or card linked to. And every time you use your debit card, every time you use this account, it looks at the cents portion of the account, of the transaction. It rounds that transaction up to the nearest dollar, and then it takes that rounding portion and puts it into your investment account. So if you bought coffee for $2.96, first of all, where coffee house are you using? And secondly, round up to the nearest dollar is 4 cents and invest 4 cents for you automatically into your investment account. This type of passive investment works on a statistics principle called the law of large numbers. If you continue to do this over a very long period of time, what you're going to find out is that you are going to end up investing, over the long run, 50 cents per transaction. That's ultimately what you're going to end up doing. Because sometimes a transaction ends in 4 cents and sometimes a transaction ends in 96 cents. And on the 4 cent transaction, you're investing 96 cents when it rounds up. Because it always rounds up, it clearly never rounds down. It rounds up to the nearest dollar. So over the long run, you're investing 50 cents per transaction that you make on your debit card or even into your checking account. And it automatically withdraws that roundup and puts it into your account. Now this can be good and bad. It's bad if you're at the border of what is in that account. So you have to keep up on what's in your debit enabled account. But the good part is if you're doing 3 transactions a day, let's say, and you do those 3 transactions a day for 20 days, that's 60 transactions, and at 50 cents per transaction, you've invested 30 bucks at the end of the month. $30 is capable of buying a significant number of stocks, 1 share of a significant number of different types of stocks. Another thing that some of these mobile app investment accounts will allow you to do is they'll allow you to invest fractionally. So you don't necessarily have to buy a full share of a stock. And we'll get into that a little bit later when we talk about actually purchasing stock. But you may be able to purchase stock in anything based on this. All right, so that's my discussion on passive investment and the types of investment accounts that are out there. So lastly, we want to talk about commodities and cryptocurrency. I'm going to say this up front. I am biased against cryptocurrency, and I will probably do a Q&A video solely on cryptocurrency of why I'm biased against it. But other types of commodities, and the reason why I looped cryptocurrency into it is because in the United States, cryptocurrency is considered a commodity. So there are a number of different types of commodities out there. Precious gems like diamonds, rubies, sapphires, etc. Precious metals, gold, silver, platinum, titanium. And of course, there's also oil commodities that you hear about all the time. If you want to invest in these type of commodities, the easiest way to do it is to go to a retailer or go to a wholesaler. Every major city will have at least one. Well, maybe not every major city, but I live in southern Texas and we have one here. You go there and you buy what you're interested in. You're interested in buying diamonds? Go to a wholesaler and buy pure diamonds. You want to buy gold? You can't buy gold bars, but you can go to a retailer or a wholesaler and buy gold jewelry. Buy pure gold jewelry if you want. Now granted, there's going to be a markup when you buy it, there's going to be a markdown when you sell it. So you're not going to get full investment value if you buy in this fashion. The other way to buy and sell commodities like oil, and I'm not certain where the market is for this. I do know a little bit about it because it's similar to options trading. But I think options trading is gambling anyway, and commodities trading, I lump it in with the same idea. It's gambling because what you're purchasing is a contract, a futures contract, and there's that whole quagmire that comes along with futures contracts. But the way futures contracts work, by my understanding, is this. You are buying a contract for a delivery of a certain tonnage of the commodity at some future date, be it gems, metals, or oil, or whatever other commodity it is. You're buying a contract for a future delivery, and then you trade the contracts back and forth amongst each other until the contract comes due, and then you make the final assessment as to whether or not you're going to buy that commodity, and then turn around and try and sell the item that you bought to wholesalers. Yeah, you're buying based on the future. And while you're doing something similar with stocks and options and the like, for me, commodities trading, there's extra issues with trading commodities, and here they are. In the United States, you pay taxes on commodities twice. You pay it when you buy the commodity because it's taxed like a sale. And there's an additional tax if you are a registered commodities trader. You have to be a registered commodities trader if you're buying futures contracts, like oil, gems, precious metals. If you're a commodities trader, there's an additional tax for buying. At the end of the day, when you decide you're going to sell, you pay capital gains, which we discussed in the first video, in episode 1. So if you bought $1,000 worth of a commodity, and that commodity is now valued at $11.25, you pay $120. You pay gains. You pay capital gains on the $125 that you made. For most individual investors, nope. This is just no. You're paying taxes twice. At least in the United States. I can't tell you what's going on in other countries, but I bet it's similar. Your best bet is to stay out of this. Now, cryptocurrency does not have a futures market. Cryptocurrency is immediate trade. So there are other reasons not to get involved in cryptocurrency, and like I said, that's going to be part of my first Q&A, because certainly you're going to ask why I'm so against it. Don't blame you, but also don't get involved with cryptocurrency. That's the end of this video. So if you have questions on what we've discussed here today, look through the questions comment section of this video. If you see your question, post a like on that question. If you don't see your question, post it into the comments section so other people can like your question if they have that same question. The questions with the most likes end up on Q&A day. I'll review videos on Friday or Saturday, post the answers Saturday or Sunday depending on when the last video of the week is. I'm expecting this video is going to be posting on a Friday, so you won't see this until Saturday or Sunday. Early on, I'll go back and look over older videos to see if any new questions showed up, but eventually it's going to get to the point of once I cover a video, it's not going to be covered again. So post your question in the comment section ASAP so people can vote on it so I can cover it just in case I'm not coming back this way. That's it for this video, ladies and gentlemen. If you like the content, please like it so that other people that YouTube says are similar to you will see this video in their stream, in their homepage. If you have friends and family that are interested in personal investment, please share this video with them so they can see it too and they can share the information with you. If you want to know about my next content or my newest content, click on the subscribe button. For full information about my newest content, activate notifications so you can get alerted through mobile and possibly through Windows 10. By the way, Windows 11 is coming within the next few weeks. Just saying. Thank you very much. That is the end of this video, and I look forward to speaking with you again in the near future.